So I posted this chart, this graph, and this screenshot in my Patreon, and I want to break down and explain for you guys what they mean, because this chart right here, or charts, I think contain a lot of really valuable information for us as Lemonade investors. If we just zoom in on one of these charts, this says, hey, this table or chart of values across two different variables are the net present value of the Lemonade shares right now based on a zoomed out 2032 valuation at a PE of 30, discounted back 10% discount rate back to today. And it also assumes you have in-force premium growing at about 30% a year. At Investor Day 2, they talked about growing at approximately 30% a year or more for the next many years until they basically 10x their business. So if you're going to 10x your business, say a 10x multiple on your premium, and you're going to do that, say, for 8 years, or say from the end of 2024 to the end of 2032, 8 years time, then yeah, it's about a 33% compound annual growth rate is what we're talking about there. So that's roughly what I'm assuming they're going to pull off over the next 8 years. And then I'm saying they have an average loss ratio, 71%, and then I'm going to assume all of their other operating expenses, except for their growth spend, grows at about 1% quarter over quarter. So if you take those assumptions, you push it into your Lemonade model here, which I'll just zoom out a little bit here. If you want to join my Patreon, get full access to this model, which also comes with more exclusive material I'm making, breakdowns, explanations of what I'm doing in the model and how I'm modeling this out. Feel free to join and do that. But the model here shows all the way out to 2032, 2035, basically assuming a certain top line growth that gets you to that 10x book of business over the next 8 years with these other metrics as well growing. Then you get a certain earnings per share at the time at that 2032 year, and you discount that back to today, you're going to get a number of a spectrum of results of what the present value of the shares could be depending on these two other variables. So these two other variables, these are really, really important for us as Lemonade investors to understand. Will be really, really, especially this one, I think, be really interesting to watch as their book of business continues to grow, as they have more products in more places, and as they expand and keep growing their marketing or growth spend or their customer acquisition costs, CAC, as they keep pushing that growth spend out and expanding that budget. It'll be interesting to see. So this variable right here says for a dollar that they spend on growth spend or on customer acquisition cost, they're getting how much premium back if you exclude the amount that is cross-selling away. So historically, I shared this here with my Patreon group, this graph right here, but I'll just bring it up on this tab. Here's historically where it's come in at. So you're spending $1 on customer acquisition costs, and you're bringing in maybe on average, maybe $2 in premium. Now that excludes the premium that you're just naturally getting by cross-selling from your book of business, which I've estimated that with different values that Daniel and others have given from some earnings reports, from some say questions that I've asked. So it's averaged from, it used to be more like 21% of premium was cross sells, upsells, and then with Lemonade, with CAR in Illinois, it was more like 36%. The overall book of business right now, as of Q4 2023, at least, it was more like 30%. I expect this kind of to trend up between 30 to 36%, somewhere in that range. So that's your other variable here that says, hey, how much of your premium are you getting free of charge from your book? About 30 to 36% is you're getting just from natural cross-sell, upsell, which is a big part of the Lemonade thesis. You're getting these customers for really cheap that are renters customers, and then they cross-sell, upsell, and they buy a car product that's 10 times the premium what their renter's product might be. So you naturally bring a large chunk of your premiums coming in are coming in that way. So based on then these two variables, where this customer acquisition to IFP conversion ratio is, by the way, this one bar is blank because that was the Metro Mile acquisition, so it's a more confusing quarter to evaluate, so I just deleted it from the results here. But otherwise, you can kind of see, yeah, it's been lower even last in Q3 because they were pushing out. They're expanding and pushing their marketing spend. Their budget for their growth spend overall is increasing. So then your overall efficiency goes down because the first dollar you spend is the most effective, and then the last dollar you spend is the least effective. So, but as they expand their opportunities, or they have CAGR in more places, and they're also attracting customers coming in the door with an attractive CAGR product, right? And then their ability to spend on growth spend should increase and at the same efficiency. So that's why, I have it kind of modeled in this table from a low of 1.2 up to a high of a range of 2. And I assumed here in my model, these values for this conversion of CAC spend to IFP kind of from 2026 onwards, assuming, a certain amount. So I have plugged in there right now, maybe 1.9 is my best guess of maybe where it comes in at. But of course, we don't know exactly what it'll come in at until we see, a few more quarters of results. But say it comes in at 1.9, and you put 1.9 from now until the year 2032, the end of that year, and you have 30% of your IFP cross-sold or upsold, then you could say, hey, the stock should be worth right now at a 10% discount rate, $82 per share. And if it was 36% cross-sold, then at the same 1.9, you might be $99 per share. You can make that argument pretty easily. Or if it's 36% and a 2x ratio, you're at 108. Of course, this is where we really want to watch this. I'm definitely going to be watching and talking about this in future videos. And as Q4 numbers come out, Q1 numbers come out, as we see the CAGR rollout expand, then this could shift. If this shifts too far down and we're at, if they only convert 1.3 times of their customer acquisition growth spend into in-force premium at a 1.3 ratio, well, it's not good news. It doesn't really matter how much you're cross-selling. It's not a very profitable business, or barely worth anything, even at this higher, more optimistic end of this cross-sold number. So you really have to keep this conversion. You really want to be keeping that above that sort of 1.6, 1.7 and above. Hopefully it's in the 1.8 to 2 range would be the really great spot. And of course, this is a 2032 valuation. I did another video for my Patreon just the other day where I was talking about breaking down some of this earnings per share stuff. And I showed, if your earnings per share, 2032 is right here, where you're maybe at $6 or $7 of trailing 12-month earnings. But if you go a few more years out, if they continue to grow at, say, at a high rate, even 30% a year, past that, well, then you're going to see your earnings dramatically expand into 2035, might be, $20-some earnings per share that they're going to be generating at that time. So, of course, what we're looking at here is just for 2032. It's really only saying, hey, until 2032, this is the range that we'd expect. If you plugged this in to 2035 and you still said, hey, at 2035, between 2032 and 2035, they're still growing 30% a year, and they grow from, say, 2032, where I have about $9-10 billion in IFP in-force premium, up to 2035, they're in the $20 billion range of IFP. If they have kind of massive growth over those next few years, then flipping back to this chart, these would be much higher values than I have shown, because your discount, your earnings per share in 2035 are much, much higher than just the 10% discount rate that we're using. But conversely, you could say, well, hey, at 2032, if they're just only worth, they only have $10 billion of IFP, and the insurance market's massive, and maybe you can argue that they're going to have the whole world at their doorstep. They still have tons of opportunity to grow, expand to new countries. Maybe you can argue that the PE ratio at 2032 should be higher. It should be more like 40 at that time. And then I have this graph here for comparison, the same value, maybe a 34% and a 1.9 ratio, which is kind of what I have in my model. You had about $124 of present value for the stock right now versus, say, $93, if you had a 30x multiple at that time. And maybe you say, well, they're going to be wildly bullish if they're going to keep growing at that rate, should be worth 60 times. And then that's where you can make the case, say, well, yeah, maybe it's worth $180 some dollars a share right now, or even if they're only, maybe you say that this is the case, they're going to keep growing, the earnings going to grow, but they're going to be spending, the conversion rate of this is going to decline as they're expanding their marketing. Maybe it's going to be a 1.6 average. You can still say, oh, maybe they're still worth $114 a share. Of course, that's maybe too optimistic. You could argue, but it's hard to say, of course, exactly what the future will hold. But I hope you found this chart helpful. I found it really helpful to kind of evaluate and think about, hey, this is where depending on where that you think this variable is going to land, which there is uncertainty there. I think we have historical metrics. We don't really have the metrics as they've expanded or pushed their marketing spend out, which they plan to continue to do. So it'll be interesting to see how this marketing holds up. But one encouraging thing, at least, is from Investor Day. They did say, Investor Day 2, they did say that they've tripled sales with the same efficiency of the same measured lifetime value with a customer acquisition cost. So they're saying, hey, they've been able to keep increasing actually increased or had the same level of lifetime value to customer acquisition cost ratio that they're seeing in customers, even though they continue to triple the amount of sales that are coming in have significantly grown. So you would assume, or you would hope as an investor, that they'd be able to continue to push that and then see this ratio hold up. This is a different ratio because it's customer acquisition cost to in-force premium coming in the door, and it's excluding what's cross-sold or upsold, which I'm breaking down as a separate variable. But I hope you got value out of this. If you enjoyed it, feel free to join my Patreon. I'm continuing to post there, and we'll be giving a lot more behind-the-scenes stuff and extra content there. So thank you so much for watching. Remember, it's in the bag.